Equity Group Foundation, or EGF in short, is a not-for-profit foundation established in Kenya in 2008. It is the social arm of Equity Group Holdings PLC that operates in 6 countries in Eastern and Central Africa. The foundation seeks to transform the lives and livelihoods of the people of Africa through programs activated through 6 pillars. These are the education and leadership development, enterprise development and financial inclusion, food and agriculture, energy and environment, health, and social protection. So far, EGF has equipped more than 33 million people with economic opportunities, skills, tools, and technologies to prepare them for the future. Education and leadership development initiatives break the cycle of poverty and develop the next generation of leaders through increased access to secondary and tertiary education, impacting 26,304 students to date. Notably, EGF's Wings to Fly program admits bright scholars from needy backgrounds to transit to secondary school. The program has an over 96% secondary school completion, with 82% of scholars attaining university entry grades. Another signature initiative, the Equity Leaders Program, connects top-performing secondary school graduates to leadership training, coaching, and mentoring prior to proceeding to university. The program has 13,775 university scholars, 633 of whom are attending or are alumni of leading universities across the world. Under the Enterprise Development and Financial Inclusion pillar, EGF stimulates job creation and economic growth by providing micro, small, and medium enterprises with advice and entrepreneurship training, and further improves financial capability and individual and household security by connecting people to expert financial education and access to financial services.
We are glad that our purpose distilled down to offering integrated financial services that socially and economically empower consumers, businesses, and communities have attracted the support of like-minded partners. I recognize the Mastercard Foundation for teaming with us to train 2.2 million bubbling young men and women to become entrepreneurs through a financial literacy program.
So far, 191,305 micro, small, and medium-sized business owners have been trained on entrepreneurship, with over 140,000 of the MSMEs have received 57.5 billion shillings under the Young Africa Works program, helping businesses to thrive. Through EGF's Food and Agriculture pillar, the program helps to create jobs, improve market access, and expand agricultural production by working in partnership with small and medium-sized farmers to increase their production capabilities and access technology and financial services. Under this pillar, 2 million small-scale farmers have transformed to farming as a business, while almost 40,000 small and medium-sized farmers have been supported to adopt modern methods of farming for increased yields. The focus of the Energy and Environment pillar is the conservation and smart use of natural resources by expanding forest cover, improving water security, and promoting the use of renewable energy and energy-efficient technologies. The pillar has impacted 780,000 households and businesses to access clean energy products, including solar panels for lighting and heating in homes, schools, and hotels. The pillar has encouraged installation of biodigesters for biogas for cooking and generating electricity to power on-farm activities. More than 240,000 households have embraced clean energy products, while 3.12 million trees have been planted to increase forest cover and conserve the environment. The health pillar provides access to comprehensive health financing and private sector-led, affordable, high-quality, and standardized health services. So far, 33 Equity Afya franchise-owned medical clinics are operating in Kenya, with more than 305,560 cumulative patient visits. Under the Social Protections Pillar, EGF has committed to reduce social and economic risk and vulnerability and alleviate extreme poverty and deprivation through cash transfers. It provides thousands of marginalized and vulnerable households living in Kenya, Uganda, Rwanda, and South Sudan with social payments through cash transfers. The foundation is involved in 22 programs across East and Central Africa, serving 3.3 million persons. So far, 77.4 billion shillings has been disbursed via equity cash transfer infrastructure. This is but a glimpse of the activities of EGF in our pursuit of championing the socio-economic prosperity of the African people. We invite you to learn more and join us.
Opportunities abound in the Democratic Republic of Congo DRC. The country is endowed with arable lands, rich mineral deposits, and an insatiable market for goods and services required by the almost 100 million population. In April 2021, President Uhuru Kenyatta of Kenya and President Felix Tshisekedi of the DRC signed a bilateral agreement that would see greater collaboration between the two countries. The agreement culminated in a 15-day trade mission to the DRC organized by the Kenya and DRC governments and facilitated by Equity Group.
I believe it is a moment of rare regional and continental pride as we witness our local enterprises coming together in the spirit of one Africa, one people.
And the theme, Unlocking Trade, Tourism and Investment Opportunities in DRC and the Great Lakes region, the trade mission attracted more than 300 Kenyan investors, entrepreneurs, and small and medium enterprises (SMEs). The delegates first jetted into Kinshasa, a metropolis that is home to more than 16 million people. They were led by Kenya's Trade Cabinet Secretary Betty Maina, Equity Group Managing Director and CEO Dr. James Mwangi, Equity Group Chairman Professor Isaac Masharia, and the host, Equity BCDC Managing Director Celesta Mukeba.
We are very, very entrepreneurial. We seek new opportunities, and I've actually met Kenyans who have been in this market doing business for a while already. So this is, I think, for me, a great opportunity, and we present the opportunity in Congo as an opportunity for Kenyans to come and set up here.
The Kenyan entrepreneurs, captains of industry, and government agencies representatives were joined in the business forums, exhibitions, panel sessions, and site visits by more than 2,000 Congolese counterparts who were also keen to forge business partnerships.
J'ai la ferme conviction que la mission commerciale RDC-Kenya visant à rapprocher nos deux pays est de nature à renforcer nos relations en matière d'échanges commerciaux transfrontaliers facilités à ce jour par la zone de libre-échange continentale.
It's not every other time you get such opportunities where people open doors, actually walk in, see the opportunities, come back.
Of the chairperson of the group, we're grateful that you are physically present here. You encourage us as we release the results of the first quarter to the investors present and those online. Welcome to the first quarter investor briefing, releasing the results for the first 3 months of the year. The results for the first quarter can only be best understood if you look back the last 2 years. To a great extent, equity has been molded, has been restructured, and has been repurposed by the experience of COVID-19. We adopted an aggressive defensive strategy to fortify the bank, to enable us to be able to hold the customers, to be able to keep the rights of the economy on, and to protect livelihoods of all the micro, small, and medium enterprises who bank with equity. We wanted to ensure people continue to enjoy their dignity and their honor, and as a result, we did things very differently. The biggest commitment and sacrifice came from our shareholders, who agreed that we retain all the cash that was generated within the bank, so that we could really be able to fortify the capital buffers, the liquidity buffers, and to have the cash to be able to support the members. This yielded a very significant growth in shareholders' funds that grew to 176 billion, up from 112 billion shillings as at December 2019. So we could say was an additional 66 billion shillings that was just challenges, but we are optimistic that the microeconomic environment will enable us to discharge this year. When we look at that regional number and put it in perspective, we see our subsidiaries in the region have really continued to gain market share. They are now contributing 12.8 billion just highlight return on equity of DRC is now at 19%. Remember, we bought BCDC, the returns were at 5%, and it shows the capability of equity to replicate its model. It shows the capability of the human capital to manage business well. So that transformation of BCDC to move to 19% return on equity, when loan growth is at 14%, revenue at 29%, and our profit, as we can see, is growing at 160%, again demonstrates a winning champion, a winning horse among the subsidiaries. And I'm glad that this has started to early confirm our predictions that within 5 years, DRC could easily be bigger than Equity Bank Kenya. I'm aware the managing director of Equity Bank Kenya is in the house, Gerard. I'm saying this knowing you are looking at me, but this is a good contest to see what will happen to the subsidiaries. The fact that we have been able to diversify that risk of the group from the sovereign risk of Kenya to the extent of 40% shows maybe by the end of the year we'll be saying the subsidiaries are contributing 45%, and that will lead a spread of risk. It has always been worrying me about the concentration risk of the sovereign risk. This morning, a director asked me what keep you awake. What keep me awake is the concentration risk of a 1.3 trillion business, with 70% being in one sovereign risk. The diversification is well spoken around this presentation about the subsidiaries. So what are we focusing on? The first quarter, and we have seen the growth in the income of that 1%. The strategic pursuit is to grow quality loan book. And that is because the non-performing loan book is at a good place. We are at 8.6%, down from 11.3%, but we are aware the banking industry is above 14%. And we are saying our credit team, and I hope Emmanuel is in the house, Clement and Christine, they are managing our loan book very well. Yes, Raphael, I've also seen you. Who have I missed in credit? That team seems to be managing their own book very well, and that gives us the confidence that we can grow. So when we see the loan book growing fast, it's simply because we have confidence in the way the loan book is being managed. I think to notice about the loan book is that the loan coverage is at 95% on cash basis, on actual provisions. There is still another 26% coverage, taking us all the way to 120% through guarantees. So the coverage is not just 90%, that is on actual cash basis. There is a guarantee of another 26% of the loan to allow us to grow the loan book very, very quickly. Another area that maybe investors you need just to take note of is that COVID acted as a tailwind of helping our customers to change behavior. When we entered COVID, we were very proud of the behavior of customers towards online banking, to adapt to digital environment. But as we can see, our branches and ATMs are only managing 2.9% of our transactions. The other transactions are online, and where it's needed, they are online on third-party infrastructure. So the channels are now, the digital channels are now doing 97.1% of all the transactions. And that digital strategy, and I want to really acknowledge Lanley and his team, the payments team, Inca, that team, the convergence team. Dennis, maybe raise your hand. We are very proud of the convergence between the financial sector and the telecoms. They have availed our customers the channels. And as we shall see, the customers are now spoiled of choice. But I think the biggest celebration we have is the Pay with Equity, Universal Mobile Retail Payment Channel. Dennis, maybe you need to start. This is our hero for this quarter, making retail, helping the nations or in the markets we operate to digitize retail commerce. And you can imagine how efficient the economies will be. I was looking at the dashboard this week, and over the weekend, Pay with Equity mobile POSs processed amounts in excess of 2 billion shillings. That means that what people would be handling as cash, 2 billion shillings, they were just using their phone to make the payments. Equity, Pay with Equity, or the merchant POS, is just under 1 year old, and now it is doing 5 times the value and number of transactions to our merchant banking transaction. And yet, we are the largest merchant banking bank in Eastern Central Africa. Yet, in 1 year, Pay with Equity is doing 5 times the number of transactions. So we are seeing very, very successful rollout and execution of the strategy of digitization, and particularly making payments in the retail space. That comes with the significant efficiencies, and that is what we are hoping we'll continue to see. We have talked about loans, and maybe it will be good to look at a pictorial form, the next slide, and we can see how the loan book, the quality of the loan book is moving, and we are optimistic that this trend, we are very hopeful, and I hope Clement and Christine, I can still confirm that our NPLs before the end of the year will be below 6. Clement, can I confirm? Thank you. I can confirm. Remember, I made a promise again on being prompted by Christine and Eric that this year from our NPLs they could collect 14 billion. I asked them, can I still confirm the same? And they said they are on track. That means where the loan book will be. And that gives us the confidence that we now have got it how to lend. Because the biggest opportunity we have is that of lending. And also in pictorial form, we can see the digitization. Sometimes hearing is good, but it's when you see. We started the digital products in 2015 when branches, ATMs were all bigger than the digital offering. Today, ATMs and branches are doing 9.3 million transactions. The self-service platform is doing 314 million transactions. So if you really want to understand how big the digital platform has become, and Ashina, you can help us here, is to ask yourself, how many 9 millions are there in 314? Ashina, are they 12? Are they 32? It means that the digital platform is doing 32 times more transactions than all our branches and ATMs put together in just 5 years. And that is what we said, COVID acted as a tailwind to help our customers to change behavior. Now, digital transactions, the customer owns the device, so there is no depreciation and there is no financing cost from the bank. The customer operates their phone, so there are no staff costs. And of course, there is no cash being taken around, so there is no cash in transit cost. You don't have to pay our security firms to transform cash. That is what we mean efficiency. The biggest cost in bank is having cashiers to do cash in, cash out. That has been removed to the extent of 97%. The second cost is ensuring that cash, when it is in the premises, we are now dealing with the digital. I'm emphasizing this because this will explain the performance of the first quarter, but more importantly, it will explain the performance of the future. And it will also explain the confidence we are displaying, saying, I think we can be able to make a better and a greater contribution to transformation of Africa and society. So our confidence is grounded on that. And this looks good, but when you look at the branches, one may think that digital transactions are small transactions. They are not small transactions. Now the volume of value of transactions happening in the branches is much lower. And as you can see, this happened during the COVID. It's when people said even big transactions will not go to the branch, will do them digitally. It's that confidence that will fast-track the adaptation. People thought digital platforms are for small transactions. No, it looks the market is telling a different story. The population, the members are confident in the transactions. People might have thought the risk of cash is there, but notice Equity has significantly, successfully been able to manage the risk that went with the cybercrime. And I would like to really acknowledge Lanry's team. Delma, where are you? The head of security, and of course, our enterprise risk, Sam, maybe you could. That team has really managed that risk and has given our customer the confidence that if they follow the education we are imparting on them, then they will be safe, they are secure. The mobile platform is as secure as the branches. But the convergent team, the channel team of Dennis, I seem to be talking a lot about you. Maybe you better start. So we acknowledge, has given our customers a lot of choice. The next slide, so that people know why. Now, look at the options of channels that customers have been given. All these channels. So the customer can choose Equitel, the customer can choose app, can choose FX, can choose EasyBiz, can choose EasyPay, can choose EasyNet, can choose agency, merchants, ATMs, or branches. Before, they had only the fixed cost channel. When we did so well, they could only add the variable cost channel. But look at the self-service channel, and that is what the future of the banking. I understand today you have added another one. It's called EVA. There is chatbot. You now can talk to your bank. You don't need to even do anything on the device. You just call Eva and tell Eva what you want her to do for you. So if you want to transfer money to a regular, you just tell Eva, this is what I want to do. Eva, if you want to apply a loan, I guess you can tell Eva to apply the loan for you. You can apply the loan for you. So we are now going to a chat box, and that is, we are now discovering the power of the fourth industrial technologies. These are robots that really do. So Eva has now taken over. Those people who have been saying, I call Equity, and they are not taking my calls, Eva will never fail to take your call. Because she's called Equity Virtual Assistant. So each of us now have a personal assistant. George, I hope you recruit Eva today. So Eva is Equity Virtual Assistant. So you can see we are now offering conversations 24 hours. So, but maybe what you may just need to note is how fast these channels are growing. Look at EasyNet, that is internet banking, growing 893%. Internet banking. What does that mean? Is that the market has now got access to internet-enabled phones, the smartphones. So that it's a revolution that is happening, and that is why we have 22 CIOs, so that they make sure that, the way we used to have branch managers, now it's CIOs who are managing the businesses. And essentially, that's where the trend is going. And as you can see, it's not just transaction, the volume is growing by 621%. I think it will also be good to see EasyPay. Again, EasyPay, I guess that is pay with equity, growing 392% and volume 313. So it is not about small transactions. But you can see the brick and mortar and variable channels have started struggling. The number of transactions are all negative. The customer base, the society, the customer base have spoken, and we have listened to them. So the biggest investment that Equity is making is to ensure scalability of these channels, ease of use to these channels, and I want to applaud the team that is building these capabilities, because I now see they are doing it on a weekly basis, they are making them better, they are adding more versions, and by the end of this year, they have affirmed us will have the best tools maybe anywhere in the world, and that then makes it convenient and easy. So I want to invite those who are not enjoying the services of self-service to try us. It's quite easy to get into. But what is the impact of this digitization? And moving to the next slide. It's efficiency gains. And we saw why interest have grown. We have seen net interest margin moving up from 6.8 to from 6.4. But we can see the impact on there. But look, operating income grows at 21% and the costs are growing at 13%. When we were doing economics, I could hear the professor saying the jaws are opening and the profitability is growing. When revenue grows at 21% and it's a norm with equity with a cost-income ratio of below 50%, the jaw is not opening at 21 minus 13. It is 21 minus 13 times 2, because the cost-income ratio is 50. What we are saying is income is at a double the size of cost. Cost is a smaller number. It's half the income number, growing at 13, and the bigger number, the double number, is growing at 21%. So that will explain why the cost-income ratio can only go in one direction. I haven't seen this, and I would like analysts to challenge me, of an entity they know where cost-income ratio, and an entity of the size of equity, 1.3 trillion shillings, where cost-income ratio can move from 50% to 45% in 1 year. Hello, you taught me a lot about analysis. This one is the only one I want to teach you. That digitization, efficiency can really make the business very efficient. And that is the driver of the cost-income ratio. And then, of course, we're very grateful to have Lydia. Dilango, where are you? Lydia is not with us. We wanted to celebrate her. As you can see, while income grows at that rate, profit after tax grows by 36%, simply because it's not just the widening jaw, but tax is efficiently managed. Technical experts. I'm naming these people so that people know beyond James, they are highly competent people, technical specialists who make these numbers to look what they are. That explains the 36%, profit jumping to 11.9 billion, as mathematicians like to round that to 12 billion from 9 billion. So it really reflects what the momentum that we are talking about. And that return on average assets moved from 3.3 to 3.7. And shareholders would be happy to know that despite the 60 billion shillings growth in shareholders' funds, the return on that shareholder 60 billion is at 27.4, up from 25.4. I guess there are not many alternatives of deploying that cash. So the retention over the last 2 years to really create the buffers, while we took them as buffers to manage uncertainty, they ended up to be the 60 billion funding the new growth. As we saw the balance sheet, the previous came from 600 billion to be what it is. We are not going back to the shareholders to say, your business has doubled, give us more capital. We are saying, what we retained, we have now used it. The risk, the uncertainty has been dialed down. We no longer need it. We are not worried about, we are sure about the future, but we are well capitalized. And earnings per share has also grown by 34% to move to 3.1 Kenya shillings, up from 2.3. Again, showing the ability to sustain dividend payout going into the future. So we can really look at the P&L, and that is how P&L look like. I've talked about it. Net interest income up 31%. Non-funded up to 7%, giving us a total income growth of 21%, from 25.5 billion to 30.9 billion shillings, driven principally by income, which is growing 21%, while costs are growing at 13%. Of course, the loan provision, as we can see, they are within the normal cost of risk cycle. We anticipate it to average around 17, the long-term average that we have always registered, and that normalization of risk gives us confidence. The fact that coverage is at 95% means we are not worried about that. We are very excited that that team has joined the bank, but you can see the only cost that is growing significantly is staff cost. That is because like last year we moved from 1 CIO, we are now 22 CIOs. We are now using microsystems. Each CIO has his docket, his modular systems, so that in case there is a challenge, it's only one module that will have problems. You don't have the entire system having challenges. It's the technical skills. I think the most really revamped department is risk and cyber, and of course the credit, because they are now technology, credit, and risk. Now it's no longer the operational staff, it's the technical experts to manage a virtual environment. So we now see, because we have hired the people, that will now normalize. So we don't assume the 24 will be perpetual. They are now on board. So that growth will now grow at salary increment. What does it mean? That next year we will not be seeing 13. We hope that number will be almost equal to the salary increment level, because we expect provisions, as we have said, it's normalized. It's not going to go beyond where it is. And with efficiency, as we can see, the other operating expenses, we expect them to continue to decline, simply because technology is much cheaper as an enabler than human capital. So profit before tax, 31%, very efficient tax. Profit before tax goes up by 31, tax goes by 15. That tells you how efficient, and that's why we are celebrating Rydia and profit after tax at 36%. And that really gives us a 34% earnings per share. So that's how a profit looks like. But that story of balance sheet and profitability is never complete without looking at the financial issues. And if you look at all the financial issues, they reflect liquidity of 56.9%, capital of 18.7%, total capital to risk-weighted assets, and that's what we were saying. Capital is in good position. Loan-to-deposit ratio of 61%. That can go all the way to 85%, and that is why we are saying there is a huge opportunity to reallocate, and there is sufficient capital to highlight that reallocation. And as we can see, coverage is 95%, cost of risk at 1.2, and all the other issues that we have kept on talking about. This really is the measure of the health of the business. Now, analyzing at leisure. A story can be what it is, and it can be, as it is said, in God we trust, everybody else give data. This is our data of the health of the bank. It's not what we say, it's what really you can see. Having said that, then I want 2 minutes because the first quarter is a demonstration of the strategy that we are executing. And the strategy the bank has decided to take is a developmental strategy. I said it's good, we have done what we have, we want to use this group to transform East and Central Africa, and then the rest of Africa. We want to use it as a development tool. And so it is about Africa Recovery and Resilience Plan, and we just want to see that is what has produced the first quarter results. The objective of the strategy is to reach 100 million in 5 years. Digitization would allow us. Customers can onboard themselves. Customers can navigate on the platform themselves. They can complete their retail transactions. So we are now an enabler of lifestyle. We are no longer a bank, we are an enabler of lifestyle. And it's the convenience that we are offering that is attracting the 100 million customers. It's not the fact we are a bank. We don't believe we are competing with the banks. We are competing with the needs of the customers. We are competing with human needs. Are we fulfilling them well? Are we fulfilling lifestyle? And that is why we can get 100 million customers, because we are not competing and scrabbling for these customers with the bank. And that is why technology has become our biggest investor, because it's systems that is enabling them. It's the biggest, maybe, decision, the most important decision we ever made was to make our systems open. Majority of people thought of closed loop. We decided to have open systems so that you can plug and play. So we are now offering banking as a service. Ecosystems are now plugging and consuming banking services without seeking us. And so instead of acquiring individual customers, we are acquiring ecosystems. We are acquiring value chains. And that is what will create the 100 million, because they will become in numbers. And the second target is to lead to 5 million customers, and we are saying we have demonstrated our readiness. We know how to manage loans. We know how to disburse loans. We are digitizing the systems. The customers can apply. They can even talk to robots, the virtual assistants. And we want individuals. Beyond the 5 million businesses, we want to have 25 million people having our loans at any point in time. We want every dream, every aspiration to be. And we want these businesses to build 25 million direct jobs and 25 million indirect jobs in their supply chains. And then it's not just about growth of these businesses. We want agriculture, food and agriculture to take 30% of the loan book. We want manufacturing to take 15%. We want to become the trade finance bank of the region, the #1 trade finance. Is Kennedy in the room? And Mutuko? Kennedy, you can start with Mutuko. As you can see, they are like twins. They are always together. That is the team that has taken trade finance. And truly, they are the ones who do trade and investment. And as you can see, this week they made us sign an agreement with the World Bank Group so that they can do it with the support of the World Bank. The World Bank can open the world for them in terms of the confidence in the bank. If there are men who make us be able to promote the East African Community regional trade, if there is men who are activating the $2 billion deals that were closed in DRC, they are being done through that team. Emmanuel, you can stand if you are in the room. Rafael, you can stand on his behalf. That is credit and trade finance. The enablers. They are the ones who are enabling the African continental free trade area, ensuring trade capital is flowing. So that is a strategy, and we can see how rewarding development is. 36% growth in profit. Development is profitable. Purpose is profitable. We need to rebuild our businesses to be purpose-driven, and then we will scale. So broadly, the next page, this plan, which we are calling the African Recovery and Resilience Plan, is about relocating the idle 700 billion shillings. Remember, Equity is growing balance sheet at an average of 20%. So that 700 billion will be growing at a rate of 20% every year, compounded. So we are not talking about a static figure. It's a growing 700 billion. We're saying it's what we are feeding to 5 million micro, small, and medium enterprises and 25 million consumers. We are doing this in partnership with the national government. We have aligned the Marshall Plan to national government plans so that policy and budget allocations are supporting this effort by creating an enabling economic and policy environment to enable the private sector to thrive. So the transformation is through the private sector, is by the private sector, but the government creates that microeconomic environment that is suitable for the transformation to happen and for the private sector to thrive. We have been lucky to partner with the World Bank Group, specifically signed by AFC, who we have co-created the development plan with. We spent 4 days with 20 of their members, checking every dot on the plan and confirming its sound. As a result, we have African Development Bank and 10 European Development Banks saying this transformation will require more than your 700 billion. We'll syndicate with you. The large-scale projects, we'll fund them ourselves. The infrastructure, will fund it itself. So, and that is why government came in. The syndication is to finance infrastructure and projects in the primary sectors of transforming agriculture and mining, and of course the manufacturing sector, and to promote trade and investment, as we saw with the trade team. The UN has been kind and generous. The resident coordinators of the 6 countries have signed on this transformation plan. The UN would use its platform and capability of the UN Sustainable Development Goals 2030 to do the social impact, capacity building in the micro and small enterprises. So it's not just about throwing money to them through loans. It's first of all building their capacity. And they're doing that through the Equity Group Foundation. The Equity Group Foundation team, please, where are you? You can stand. This team, the agents of, very good. Anthony will be doing entrepreneurship and financial literacy. Salaline will be doing safety nets. Dr. Khalil will be doing health. They will be monitored and what else? And evaluated by Matthew. So Eric will do energy and environment. Margaret will do education, and agriculture is with Florence. And as you can see, it is 50-50. Where is Penny, who is keeping the books? And there is Penny to keep the books of accounts. So essentially, that is how, that is the team that is working with the Mastercard Foundation to give guarantees to the borrowers, to organize for risk sharing, and to organize capacity building behind the UN agencies. Thank you very much, colleagues. So Mastercard Foundation, in partnership with us, through Anthony, we have done Young Africa Works for the last 2 years. We have been able to train 436,000 young micro and small medium enterprises. 238,000 have borrowed. They have borrowed 139 billion shillings, and they have created 1.2 million jobs. So we know the formula. We know how much micro enterprise will require in cash. We know how many jobs they will create, and we have a spread of the sectors that they are. So we have done a very big deep dive, and we are confident of the 50 million jobs. The greatest support we have got is from the Commonwealth group. They have offered to partner with Equity to mainstream the African Recovery Resilient Plan, and they have adopted it for their Shogun meeting in Rwanda in June, so that the 19 countries adopt the plan, and then the other 54 minus 19 countries support them with the trade. So it's an integrated approach. We don't own it. We have asked for partnership. We have championed the cause, and like-minded people have joined us to execute. We are really confident because this plan is systematically planned. I want to recognize Brent and Joy. Brent, you can raise your hand. Joy, wherever you are, and Joy, they have spearheaded this. Their target is to increase productivity in the primary sectors of agriculture and extractive. That's what we are best at. We have all the minerals you want in the world, and we have the arable land. So we are saying, why don't we focus on productivity? The architect of the plan have taken agriculture, Brent, agriculture, 30% of the reading. He's now at 14%, up from 3% 2 years ago. So we are making very, very good progress, reallocating resources where they are. Sam Kitwekere, you are leading manufacturing. Sam Kitwekere is the chief risk officer. We said that is where the risk needs to be managed most. Let him ensure the factories are established in Africa to process agricultural produce, stop selling raw materials, stop selling dust. Let's process in Africa. And we are glad there is a possibility, and we saw DRC sign with the government of Serbia to set up the first cobalt battery factory, and we are financing that with the World Bank just to make sure the factories happen. We have financed the largest pharmaceutical company in Africa, in Uganda. So the industries are starting to come up, one at a time. And once each comes up, then the whole sector. We have talked about investment and trade, attracting global, local, and regional capital, or to build regional supply chains. And the timing couldn't have been better. The global supply chains are broken. We need to build local and regional supply chains. And that is where the manufacturing sector is centered. We couldn't have been better timing other than a time when we have enlarged the East African community by having DRC join, almost increasing the size of the market by about 60%, 62%, bringing 100 million population into the market, a market of 300 million people. That is the size of America. It's only GDP that is lower. GDP per capita. So, but the consumer market is big enough to be able to support the manufacturing sector. And it's value addition in existing raw materials. So we are not going to look for raw material, it's processing the raw materials that we have been extracting. Supporting the micro and small enterprises, again, that's where the own division. Jeremy, are you in the room? Jeremy leading the micro small enterprises is the second largest sector in the group. That's where the 700 billion is going, and we trust that that will really go a long way. And of course, is supporting sustainable development. So we are not doing it the way the agrarian revolution was done. We are doing it smart with green financing. We want clean energy from day one. You saw us saying no coal here. It is Africa who set the standards of how development should be done. And Leshma, maybe you could start. We are being headed by Leshma. Where is Eric? The two of them are the giants of ensuring preservation of environment, sustainable development, and growth. So it's very simple transformation we are talking about. It's a 5-point agenda. You know, we have just added one to the big four. Kenyans, we have got used to the big four. Now we have added just one to say there are just 5 pillars. Simple, everybody should be able to understand and play their rightful. We'll give you a copy of this. So the next slide gives you a detail of how these pillars are organized so that you can also start being a partner. George would be willing to finance the first factory you set. So that you have the details. The next slide gives us the confidence. That is how we project things will grow. We are already on target with loan growth. We are lagging a little bit on deposit because the focus is to disburse the loans, because if you get money which is not being deployed, it's expensive. We're confident we'll be able to get to the interest margin. We are confident the non-funded income mix will get there. The cost-income ratio, we have already made it. Equity, we have made it. Return on asset. So the projection that we had now, you can scale it for the year. I think it's really a bit. Why are we able to deliver this? So we tried to answer this question. Was it that the targets were easy to get? And the answer is no. And the next slide really then explains. We are beneficiaries of improved prospects for regional integration and economic growth. DRC is playing a big role here. Continued global economic recovery is a major driver, and it's what is the tailwheel in our support of agriculture, manufacturing, trade. So all that are supported. The efficiency of the balance sheet, we believe that we have the cash, so we are not bothered where the cash will come from. The possibility of improving yields, that is why the management is very confident, because we have not even applied the risk-based credit pricing. It has not come into being. We don't need to provide, the coverage is good, and technology has enabled us to be very, very efficient. And the opportunity of cost optimization, as we saw, is real. So that efficiency is what will fund the transformation. So I want to stop there and thank you for listening. But the people have been making to start are now ready to answer the questions. You know where they are. I did direct the question to them. Thank you very much.
Questions?
You have talked, am I being heard? You have talked quite a bit about efficiency in provisioning, but this again is we have to look at it against the backdrop of a huge war chest. So how do you strike that balance between prudent provisioning and ensuring that the cash goes out again to this 5 million targeted population? The DRC that you showcased to, that you brandished in the face of Gerald, you have said that it is a testament to Equity's brain trust and capability. Who is driving that at a personnel level? Is it Gerald's donated staff, or is it indigenous local staff down there?
Let me say at the group level, it's being driven by our group executive director, Mary, long-serving director, formerly director of strategy. Before that, the company secretary, she understands the strategy. She handed it over to Brent, who was working under her, so she understands what needs to be done, so she's now executing. So she oversees all these subsidiaries. DRC is connected to the shared services of the bank. So again, there is a lot of support. When it comes to credit, it's shared support. The credit team will support them. The legal team will support them. But you need to adapt the equity group to the nuances of a market. So when it comes to the men and women on the ground, they are experts in French speaking. So it was easier to get staff. We were very, very lucky that our first investment in DRC was an acquisition of a German bank. So the management were, all of them had been trained for 3 years in Germany. They are all fluent English speakers. We realized that we shared the values, and they demonstrated what they were made of. We bought a bank that was $150 million. 5 years later, it had grown to $800 million, and it's at that time that we acquired BCDC. So BCDC, we handed it over to the management of Equity Group that was already in DRC through the merger of Equity DRC with BCDC to form Equity BCDC. So the investment is in safe hands. We share the culture. They were using our equity centralized systems. So if you were perceiving a risk, it's minimal. Culture had already been integrated when we acquired ProCredit. So that really explains. Now, there is always a balance between liquidity. High liquidity of 60% means low returns, because you are investing short-term in 7%. You led at 14%. It's almost double the rate. So you can accommodate a level of risk. The question is the discipline in credit lending that is required. And our team has really demonstrated that the NPLs have the rate of the market, so that demonstrates competence. But also the special purpose team that is doing collection, or the special collection team, is able to correct even where there is default, because documentation was right. So I would say we are able to balance that risk. But we are also willing to take the risk, and the return should not be measured in cash returns. It's not in profitability. It should be measured by how many lives we are able to transform by empowering people to realize their dreams. The best return for equity would be the dignity and honor that is enhanced among the members. And the last one is we measure ourselves by how much we have expanded opportunities for wealth creation. And I say that because that is our true north, because our purpose is to transform lives, give dignity, and expand opportunities for wealth creation. So if we get that return in terms of 50 million young people getting jobs, maybe 5 million East Africans being able to join the supply chains and ecosystems of the manufacturing sector, of the agricultural transformation, then we will have really achieved the objective. So I would really like George to persuade you to look at return in terms of how many lives will we transform, how many people will we give dignity, how many young people will we give jobs, and how many entrepreneurs will grow their enterprises. I don't know whether, Sam, there is anything you want to add, because this is a risky question.
Thank you, James. In addition, obviously we seek well-controlled, high-quality growth in the market, and we see opportunities for that. In pursuing that, we deliver good returns, low provisioning. James has already mentioned the recap.